This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL Coveel. Not filtered, raw, honest. That's my passion. My guest today, Jerry Parker, one of the original TurtleTraders trained by Richard Dennis. For those of you that draw a blank when I say that, you say, I don't know what that means, Mike. You are speaking Morse code, some type of language that disappeared eons ago. That means you have not yet read my second book, The Complete TurtleTrader. Pick that book up immediately. Yes, it's not going to break the bank or anything. It is the true story, absolutely true, a freaking Wall Street legend story of brand new, essentially no experience students, I don't know, ages 18 to late 30s, taken off the street, given rules by one of the most successful traders of all time, Richard Dennis, given rules and said to those students, take these rules, and they were trend following rules, take these rules, go trade, and let's see what happens. Well, they made a lot of money. These rules, these foundational trend following rules that the Turtle Traders learned, Turtle was a nickname, trend following, just trend following, the base strategy that every type of trend following trader you can imagine would use to this day. Now, there's going to be different wrinkles here and different wrinkles there and different portfolios here and different leverage choices there. But foundationally, trend following, and that means the trend following that the Turtle Traders that my guest today, Jerry Parker, learned, is really based off all of the work that guys like Daniel Kahneman and Amos Tversky figured out. That human beings are crazy. And when it comes to their money, greed and fear dominate. So if you know that greed and fear dominate, how can you take advantage? Boom, that's Trend Following 101. That's where it starts. So my guest today, Jerry Parker, one of the first original Turtle Traders. And boy, has he had crazy success over his 4-decade career. I know people like to say, oh, this strategy or that strategy, it goes away. 4 decades? Give me a break. And Jerry's not an outlier. There's plenty of people out there, plenty of trend following traders with these multi-decade track record experiences. It's just an amazing story. This is not Jerry's first time on this podcast, but I love having him on. He gives a very down-home perspective. He has a very, very straightforward way of breaking down and explaining how it all works. And we can learn from that. But you really have to start. If you have not, most people have, you really have to start with my book, The Complete TurtleTrader. It really gives a foundation. And for those of you that don't know about this, The Complete TurtleTrader came out in 2016 with an audiobook. And that audiobook has a special interview, a special behind-the-scenes interview with Jerry, beyond the podcast today, but a special interview on the audiobook of The Complete TurtleTrader that is only on the audiobook. So I really implore you to check that out. I think you'll enjoy that as well. Without further ado, let me jump into my guest today, Jerry Parker. I hope you enjoy this episode.
The end of trend following, I kind of doubt it. There's a lot of people who criticize trend following. Once again, I'm pretty shocked at how they need my help to articulate why it might not be working and how it might fail. The lack of understanding basically of how it works. I have no problem with someone using logic and saying, okay, I think we're at the end here because of the false breakouts and the crashing markets. And then I would respect that. But a lot of the criticism comes from other people who really don't really understand what it's all about.
That gets at kind of my bringing up Kahneman's perspective, the thinking fast, slow, which, the kind of prospect theory, behavioral work It's like, has human nature changed, Jerry? I mean, look, there's been drawdown periods in the past. There'll be drawdown periods in the future. That's the nature of trend following. You're always kind of like, you get to a high water mark and then it's a drawdown again. That's kind of pretty typical. But has behavior changed? Because I got to tell you, when I look at these cryptocurrencies, I mean, it looks like 1980s commodity markets to me.
Yeah, but you can't just pull out one market and say, "Oh, wow, trend following works." It's really all of the markets, and the more markets we trade, the more diversification we add to our portfolio, the better. And yet, each market is worth less and less. You just can't really pull out one group of markets and say, "Well, this proves anything." But yeah, I mean, I just think that taking small losses is tough for people. Sticking with the trend and not getting out too quickly is tough. It's tough, psychologically tough. The whole trend following equation is sort of tough. I think it's not as tough as it used to be because so many things are quantified and computerized. Still, it doesn't matter. I mean, all the people out there who are trading incorrectly and properly by taking large losses and getting out of their profits quickly, we ourselves, the CTA community itself, can destroy our business by everyone getting in and doing the same trade at the same time in large quantities without regard to the liquidity. And when I used to trade over 2 billion, I would watch some of the smaller markets move around, and it would be unsettling to see some of these big moves in cocoa. But it was never me. I was buying 5 lots at a time and just taking a day or 2 or 3 and just understanding that it didn't mean no good to indiscriminately throw on a big, huge trade because I was just going to get a horrible price back. I think the sort of people who are large CTAs need to sort of get together and talk about these things, like how can we not cause so much trouble in the markets, because it will come back to harm the industry, because another period of Dow down 1,000 will be better investigated the next time as to what people are doing and who's doing it.
Just to clarify also on diversification, I often get questions from folks that are asking about kind of one market in isolation. I'm like, well, I don't know how one market in isolation as a trend following trader works, because the idea is when you start the year, you don't necessarily know where your profits might come from, where your profits might not come from. But you can have different big trends in different years, and your profits can come from those. I guess that my point with bringing up Bitcoin is it's one of these great, behavioral trends, tulip mania, and it might go a zillion times higher. But I think with it not being a market that is freely liquid in the way that you would think of as freely liquid markets, it kind of probably is not a positive thing for trend following traders to look at that, as outside of their portfolios, because it's a massive trend.
That's another great thing about systematic trading that I've experienced over the years is when a new market comes along like this, and hopefully there'll be many more in the future, you're an instant expert. You just plug it into your system, you collect the data, historical data, you're trading every market the same way. The longs and shorts are traded the same way. So you need to understand the correlation aspects of this new market, and then you put it in there, and then you own it. It's yours. I've done that many times where a brand new market had a big trend right out of the gate, and I made a lot of money on it. It really is nice that we are probably going to see a lot more new markets over the years.
But what's funny is that you're quite well known for some quotes that I have found of yours over the years that I've just loved, where you've talked about applying your methods, your trend following methods, to markets that people would never expect. And why not? If there's a price there, you can trade it. I mean, look, a lot of different people will listen to this podcast, but the idea that you, Jerry Parker, with a system can allow yourself, your firm, to be an expert in a market that you might otherwise not have any fundamental knowledge about, for example, a Bitcoin or Ethereum or something, and that you could go in and trade that successfully, given liquidity and whatnot. That's a pretty amazing concept.
Yeah, well, I'm not an expert in any of these markets, so it's a great concept. So maybe we give up a little bit by not relying upon our experience or our gut feel I doubt it. We don't probably want to do that. We want the systems, execute these systems without regard to all of the things we've quote unquote learned over the years. So that's pretty amazing. And then when you do that, you have every liquid market at your disposal. You can create a very safe portfolio. Long, shorts, it's really just an amazing thing. But we just need to have a preponderance of large moves and trends. But if you only traded stocks like most of the world, and that was your whole portfolio of markets, then, there's been times where stocks have not performed. Obviously, '08, the lost decade. It's painful, it's not fun, it's not good, but I really don't see an alternative to systematic, long-term, diversified trend following. Which one of those are we going to give up? The systematic piece? I don't think so. I don't think that's the way to do it. Not diversification, not the long-term piece. We're going to start taking large losses and taking small profits. It's still the best thing we can do. We're still churning water and preserving capital, and really just focusing on the fact that I think this is one of the cornerstones that I try to tell people all the time, is that stock trends are not superior to other trends. Now that is really crazy talk right there, because it certainly does look like
that's
it.
Deep, and that is something that goes right over people's heads.
If that's incorrect, then oops, my bad. But I'm pretty sure that 2.5 years is not enough.
Why don't you elaborate on that? Because what you're really saying, and I think people just really might shake their heads. What you're really saying, guys, a trend in coffee, is worth. And, the same as a trend in Tesla. I mean, all other things being equal, the same price move. And that just doesn't register. Hold on, coffee? But Tesla's so cool.
I think that people do believe that the stocks they just have more big moves. They're always trending. They have been very good at different points in time, but so are the commodities and the currencies and the bonds. So I don't really see any evidence that the stocks are inherently superior or it's worth trading all of your money. You've got to get Eric Crittenden back on your podcast, because he shared with me a research that he did about stocks, and it was absolutely amazing research, because at the time we were talking about the sort of popular news articles that have been out about how 4% of stocks account for all of the profits in equities. And over the years, the small percentage of stocks make all of the profits. Most stocks don't make more than the treasury bill rate. Lots and lots of stocks don't make any money, they lose money. He shared with me this research that he had done where he had just looked at stocks that were no longer in existence. They had gone out of business. They'd been merged. They were the missing stocks, and he used a trend following system on those stocks, and they virtually made about the same amount of money as the stocks that were still around. So trend following rehabilitates and changes all the statistics of the buy and hold in markets. So here you had the worst stocks possible that didn't make any money, that went out of business. They were good stocks to trade. Trend following it's definitely a mandatory part of every portfolio, and it is a little frustrating to read a lot and listen a lot to people who sort of look at the world in a buy and hold mentality, and yet they at the same time do agree that momentum works, and they're not going to. There's too many academic papers out there to disagree with that. But when putting the two together, they just can't. It's hard to bridge that gap.
I would tell people, and I'll remind people at the end too, that if they want to come into your world and find out what you're interested in and your views on current happenings, your Twitter feed's a great place. And I told you in advance that I was going to kind of go through and pick some of my choice nuggets, because you can get controversial on a podcast, but you get really controversial on Twitter.
I think that's the place to do it, and in a nice way. I mean, I learned some stuff on Twitter. I've been wrong before. I know you find that hard to believe, but it is kind of fun and intriguing to play around with Twitter and to learn from a lot of smart people.
There's a line that I caught on there, just kind of a lead up to. There's a line that I loved, and I would like for you to explain it to the audience. And it's just something that I pulled from your feed. Value investors are the real speculators. That's one of those controversial type statements.
Well, I'm pretty sure that's just a quote from the Wall Street Journal article.
Well, yes, but you're a master at pulling things and just leaving people to think through, why did Jerry pull that and put there?
Yeah, well, I guess I'm saying the answer is in that article. But I don't know, obviously that's kind of an easy one, and maybe I'll twist that to what I really believe by that, which is, yeah, it doesn't get more risky to carve out one sector and decide I'm going to trade with one sector. Yeah, then don't be surprised if the average return is 7 or 8% with a drawdown greater than 50%. It's just amazing how when you add currencies, commodities, and bonds to that portfolio, long and short, how it makes life so much better and easier. So you may make the same 8% return, let's say, but with 20% drawdown or half the drawdown possibly. So it'd be difficult to be as bad as buy and hold just by the mere fact that you've added some other markets and maybe did some shorts as well. And then I guess the value of trying to pick bottoms and buy things that are going down and is a little scary, the trend following of small losses and paying attention to price only. And if it goes against you, by definition, it's a bad trade and you should reduce your risk. Versus the opposite of that, if it goes against you, it's a better trade. Now let's buy more. I don't think it's difficult to see that that's kind of a risky thing. But it's always worked, and it works. Okay, that's good. The world is always changing, as you just said, and things that are never happened before are happening. Values in this big decline, and from a money management point of view, you can see how that could really spin out of control if you took it seriously. Sort of the opposite of trend following is something I would want to stay away from.
Why don't you speak also, and this is one of these nuggets that I also pulled from your Twitter feed. I think the body of evidence, and I'm not sure if this is a quote directly from you, but I think the body of evidence would favor trend over value for crash protection. Now, look, I already can see people as I start to talk about a quote crash. Some people have already tuned out and they're already saying, well, Mike is talking about a prediction. Now he wants Jerry to talk about a prediction. Not at all. But the whole thinking of having this system over this widely diversified set of markets is such that when you have equity markets taking it on the chin, and they'll take it on the chin at some point in time in the future, there's a crash protection in this trend following strategy that's very unique and it's very cool.
Yeah, I mean, it's not going to work all the time or every time. So I think it's two different pieces to that. One is humbling yourself and paying attention, submitting your ideas to, well, what's going on with the trend? And so putting yourself in a situation where the mere fact that it's going down and you're long, you're going to be defensive. You're going to reduce your position or you're going to get out and you're going to be looking maybe to get short. The way trend following works, it is going to help a lot there. And then you're not going to try to find a bottom and look at lower prices as a bargain. So let's hop in now that it's a bargain. And then again, it's back to the diversification that even if you're sort of caught in a bear market and you didn't get out in time or get short in time, you still have a lot of other markets to look at that will offer some level of diversification, hopefully. So it's really a defensive, conservative way of managing money. Now, over the years, I think I could be guilty of using too much leverage or making it look like it's not that safe. But in essence, it's a pretty safe way to manage your money.
I mean, risk of ruin is not something that I think is probably on the lips of the typical passive stocks only, long only mutual fund manager, whereas risk of ruin is something that you have been thinking about since the early 1980s.
That's right. I mean, it's nothing more important than being around to play and to preserve your capital. And I think it doesn't go without saying, because it needs to be said, that there's little that's more important than the proper choice of leverage when you first start out. You don't want to get into this with higher leverage that you can't live with. That's going to make you not do the trades you need to do. That's sort of the secret of all of this. Do all the system trades all the time for the rest of your life. So you don't want to get into a situation where leverage prevents you from doing that frequently. Sometimes, no matter how good the system is, you can Monte Carlo it to where it's going to show a drastic drawdown. So you need to have another rule in place, which is that when you hit these levels of drawdown, you reduce your leverage, reduce your positions, reduce the size of your future trades materially until you sort of and continue to do that as you lose, so that you can preserve your capital. So I'm just sort of saying that you can't fall in love with these systems. You've got to exercise some methods out of the system, reduce your leverage. So if you're down 10%, reduce your leverage by 20%, and reduce all your future trades by 20%. So reduce your leverage and your risk quicker, fast. You make your risk of ruin or your risk of getting to a certain drawdown level that might be ruin for your business less and less likely. So no system is immune to that. But once again, I've seen people run these numbers and say, oh, risk of ruin is too high, it doesn't work. And I would sort of agree with that. I mean, their agenda was to trash trend following, but yes, it's absolutely true that these are not religious experiences and things that you can rely upon. You need to preserve capital, reduce your risk, and do whatever it takes to stay around and keep your money, keep your assets under management. If you continually trade too large and your average profit each day is 2 or 3% profit or loss, and then you're going to get yourself into having to frequently do these risk-adjusting trades, and then you're sort of not able to follow your system.
Jerry, I had a lunch today with a young guy around 30. He's had some success with these ICOs and Bitcoin, and he doesn't have a strategy other than the fact that, as many people in this age bracket that I've talked to that have been investing in Bitcoin or buying Bitcoin and some of these ICOs, they're just getting in without a real strategy. And look, this is your 4th decade of watching markets, watching behavior, talking to people constantly. Is it interesting to you to watch the latest generation going through their latest kind of first market forays and the latest big trend run? I think when I look at something like trend following, I look at human behavior, and people wonder, why will trend following continue to work? Well, it's like, when are people going to stop being people?
I'm not really well versed on this Bitcoin. I do think it's kind of fascinating, and I do like the idea that there is something that you can invest in that a computer generated, and it's not really a currency, but it's just something to invest in, like gold maybe. And hopefully it all ends well, and it does become something that's safe and stable and a mutual fund, and people don't lose their money. But I do think it's very interesting to watch, but I really don't understand it. But I don't really understand soybeans either. So I act like I do, but I probably really don't.
I wish we could see your face as you're saying this, because I think you're kind of like just, you're saying to people, hey, look, I'm a trend follower. Like, yeah, Mike, I can go down the path with you and I can speculate about the foundations of some of these market moves and this and that, but I just don't know. And by no means are you trying to pass the buck or say I'm not being wise about my investments. You've just got a very consistent, and I think a fair word for a trend following trader is it's a boring strategy. There is no, Jerry Parker doesn't sit down and lock himself into a cockpit chair every morning with 15 monitors in front of him, with IVs of juice into your arms for whatever reason. I mean, that's, I don't think people even have I remember walking into your office for the first time in Mannequin Sabbath. I thought I was in a law firm.
Yeah, it kind of was a law firm, but we rented space from, but yeah.
It's something that still, even though you're in the middle of this, you live it, you breathe it, you give some examples about how CTAs are perhaps crowding out trades and stuff. But I think if you and I were to take a random sampling of 1,000, let's say, doctors and attorneys, what percentage of them would really have investments in trend following or even know about the basics of trend following?
That's a good question. I think they know the basics. I'm not sure how they don't have more of investments in trend following, but I think everyone kind of understands the basics. And in 1981 or so, I read about trend following, read books and newsletters and magazine articles and things like that.
How are we equating you to just the regular guy? I'm not saying, you are a regular guy, I get that, but you've kind of gone down a certain special path when it comes to trend following.
Yeah, but even before I got started, I was an accountant in 1981. I was learning about it, and I thought it was wonderful. I thought it was great. I understood exactly how it could work. And basically, it's, do these small losses, do the big profits get paid by this? Do you have enough big profits to pay for the small losses? And I instantly liked it and thought it was great. I'm a little skeptical of people who don't invest because they don't understand it or they can't like it. I mean, you got to like it. There's nothing not to like. It's absolutely wonderful with the diversification, the risk control, and the equation. Can 60% of the losses be overcome by 40% of the winners? I think, once we have another bad period for traditional assets, then people will become instant geniuses and experts on, oh yes, I know exactly how this works. And I think it's just a matter of time before it comes out that people are more. And I'm always reading about how the CTA industry is growing. There may just be a few people, but I do think people instinctively understand exactly how it works and how it could help them. The more this bull market goes higher, people are fairly skeptical, I guess, and understand that other markets, gold and currencies, that's some things to look at.
You're 4 decades into following trends. Can you remember any trend, any market where, maybe there were some, but can you remember any point in time where, the market was going one direction and maybe perhaps a nice, steady one direction and then went the other way? It's always a surprise, isn't it?
I think so. I can remember sometimes where it wasn't a surprise and I was like totally dumbfounded by it. It can happen where people are, sort of can talk about a trend ending, and it does happen. I would just say that that's one of the lessons, is that any pattern and set of circumstances you can imagine will happen eventually. Just shows we don't really have a lot of data, enough data to sort of know exactly what's going to happen in the future. Maybe if we even had a lot more data, we still probably couldn't predict what some of these patterns would happen. But I'd say by and large, it's much better to get into a trend where the market is the fundamentals and the news is one direction and the trend is another. I've definitely seen that on some trades I've been in after some long-term trends where the market got bullish news and should have continued strong, but it reversed. And so that's kind of another, I think, a good discretionary move that we were sort of taught to pay attention to the trend so much and only the trend. But then if you did get some sort of news item that seemed counter to the trend, and then, maybe that would be a fun spot to play around and just do a 10% discretionary move. So that was definitely part of the turtle story that I don't think it's told a lot. The sort of contrary opinion, fade the news. Fade the news, fade your friends.
One of the things that I grabbed from your Twitter feed that I liked, and I've seen this in different incarnations over the years, and I'm kind of paraphrasing a little bit here, but you were talking about the idea of kind of a back of the envelope algorithm, something simple, so to speak. And you were kind of contrasting that with those folks that have the view of this optimal or complicated formula, or they have this expert judgment. The idea of simple alone causes people to discount it. They don't see that there's so much goodness about simple applied consistently versus those folks that think they can find this optimal supercomputer, something another that will guide them. The simple gets kind of discounted and not accepted.
True. I think that's true. I think another thing to emphasize on that statement, which I got from someone else, which has a link on my website to the actual person who said this. I don't remember who said it, but I think just, first of all, choose the algorithm. That's the big one right there. It's okay, simple is good, but choose the algorithm. That's going to help you. So be a person who is prone to rules and following rules and understanding the power of these rules. So number one, right out of the box, you got to choose the algorithm. Now we can move on to simple or not simple, but really that's the fundamental foundational idea. Please choose that system. The consistent application is going to, more than likely for most of us, overcome the discretion. I think that really at the heart of this, and this just doesn't get talked about enough, but if you go back and listen to our podcast, I mention it every single time, is why the simple algorithm, or why the simpler is going to be more powerful. It's really because of the sample size. The more you add variables and try to find just the A+ trades, and the perfect system that enters and exits and does 5 trades a year or 50 trades a year or whatever, you're just going to lose a lot of sample size and of historical trades. And so it's going to be a weaker system because it's fitted to the past, maybe not as much as it needs to be ready for anything in the future. I had a friend who told me the other day that he trades systems that doesn't really work that well in the past because he wants to be ready. Now, there's still trend following, let's say, but he doesn't even care about optimizing, and he can do any research he wants to do. He just doesn't care about optimizing and choosing the perfect parameters as much as just having an approach that is maybe enters and exits using parameters that haven't been that great in the past. I think that's sort of the key is getting, number one, you can't miss these big trends. And so back in the day, filter was a bad word. We didn't want to have a filter because all it meant to us was you were going to filter yourself out of a big trend. Entries are very important. In some respects, the entry is more important than the exit because the entry, you've got to do the entry. I mean, that's just the bottom line. If you don't do it, then it's a type 2 error and you have nothing to protect yourself. If you have a type 1 error, a bad trade, you're going to take a small loss. You got that covered, but there's nothing. If Bitcoin is in your portfolio, let's say, then you've got to take that Bitcoin trade every single time the system signals it, because if you don't, you're probably going to, you'll choose the time you're going to miss a big trend. So nothing more important than following that system and having a system and doing each and every trade. The absolute most important thing.
I was telling this associate of mine that was we were discussing Bitcoin, and he was kind of asking what should my exit strategy be in? What should my exit strategy be? And I said, well, imagine a peak. And I said, I'm not trying to give you some system right now. But I said, but imagine a peak, and maybe you come off 20 or 30% off that peak, then you got to get out. And you could watch his face as I said that. It was kind of like you could see the wheels turning. The wheels turning where, hold on, if I get out 20 or 30% down from the peak, what happens if it goes back up? It's just, right? You can see the wheels turning, right?
No, that's hilarious. I did remember asking Rich, during the Turtle class, during one of the coffee breaks, like, what is the biggest mistake we're going to make? And he said, not getting back in. You just got to get back in. So you take the small loss, or you got to get back in, and then got to get back in at new highs. Oh my gosh, new highs. Got to wait for new highs? That sounds crazy. Or, you get out prematurely, or not even prematurely. If you follow your system and you exit when it closes below a 200-day moving average, if it goes back up, you got to get back in. Wow. There's your Kahneman, there's your human nature. That's difficult to do. I got to get right back in the same market. This market has it out for me. I've lost 5-10 times in a row. Certainly can't have to get back in. I'm going to nuance this a little bit. I'll buy the break. I'll make sure it goes up, and then when it comes down a little bit, I'll buy it there. That'll make me feel better. So a lot of things haven't changed, and they never will change. But it doesn't mean the CTAs can't screw it up by selling 50,000 S&Ps on the open to vol target their portfolio in August of 2015. So I don't know if that happened or what happened, but that was unresolved as to. And it's really a black mark on our whole business is what the hell's going on when these vol targeting trades hit the markets in quantities and size, whether it's probably the bid is pretty low and it's really a bad time to be trading large. Sorry to keep harping on that.
No, I think at the point being there, and I'm going to bring it back to something you just said about Rich though too, the point being with the vol targeting is that, okay, this strategy, some firm might think this particular strategy is working for them in the short term while we're in the middle of this massive U.S. equity boom. The markets seem to generally have a way of neutralizing bad behavior over time.
Yes. Okay. I'm down with that. I just hope that I don't get neutralized out of business. So, yeah. Sure.
When you were talking about Rich, though, it made me think, it's like, the idea of buying those new highs. as kids or as young adults or your first house, everybody wants to go to the yard sale and get it on the cheap. When you buy your first car, you want to negotiate for the best price. You want to have, when you buy the first house, you want to keep dickering down to get the lowest price you could possibly get. It's the exact opposite of what you should be doing when you're trading.
And I think some of those situations, that's the right thing to do. Definitely dicker down on your house and get it as cheap as possible. But trading liquid markets in a portfolio of all the different asset classes and different markets and time zones and countries, long and short, if you want to pull money out of that market, then I think, what we do is really good. And it's pretty sure my guess would be that everybody who's been in the business for a long time has pretty much the same formula. Diversification, small losses, don't get out of your profits too quickly. They're not going to call it trend following or whatever they want to call it, but paying attention to price and letting that, because eventually you will be got and you will have trouble continuing to try to buy the lows and not take small losses.
There's another one that I love from your Twitter feed. You were quoting Cliff Asness, and he was quoting somebody else, but basically this person had said, we need to make money in the short term. Cliff basically said, the rest of us like lower sharps. Oh, we forgot. Never be down are bad. I love the sarcasm there. We need to worry about our short term performance. Like, who dials in and controls the market, so to speak, whatever market we're talking about? I mean, it just doesn't work that way.
And most of us have material amounts of our own personal wealth in these approaches, So, golly, I would like to trade very short term and not have these losing periods. I would do my best to do that. Nobody wants to experience these drawdowns or bad performance. We're all trying to do the same thing. But I do believe that this is sort of why the systems kind of work. And because essentially you're asking yourself, and people are asking you mean to tell me you are not going to take this profit right now until this trend reverses in your system, by your system's definition, and you're putting your fate in the hands. What about tomorrow and the day after? You're like, I'm not going to, and I'm pretty much just going to let happen what happened. And I think that that's so difficult to do. You have to experience a lot of years of seeing it work, and then seeing you do the opposite, and the opposite of that doesn't work, overriding your systems, of course. And so you do need to fall in love with being out of control and not pretending to have control in these markets. You're exercising so much control, more than almost anybody else anyways. Currencies, commodities, stocks, bonds, long, short, systematic, small losses. So you're really the only one in control, or to the degree of control that you have over this world and investing. But you can't go over that line and think you can do any better than the back of the envelope.
Jerry, have you found yourself over the years with a trend following thinking, a systematic thinking, has that thinking crossed over into other areas of your life?
I appreciate, the systematic way of looking at things and solving problems. I definitely, when we first went to Chicago in 1983, we also was my first introduction to sort of baseball books and Bill James and looking at baseball in some sort of mathematical, systematic way. Definitely look at all the sport. I love sports and look at sports in that particular way, trying to understand what's going on in the different sports and what makes a winner and what are the characteristics. And I think when your whole job and livelihood is dependent upon trading and trend following, then you definitely feel more comfortable approaching life and problems in a sort of a systematic way. You're just always continually reminded of how things work when we don't. So that's kind of painful and I've done it in my investments too. I remember I invested in TIPS, these Treasury inflation protected securities, and your brain just sort of switches off. So I bought a lot of these TIPS just as an investment. Rates were low and this was 5 or 6 years ago, and rates were low, and I'm thinking, okay, it looks like a good investment. I'll buy these tips, Vanguard tips. And so I bought it, and I was just like totally confused. Like, what are these things? How do they work? I need to understand this calculation, blah, blah, blah. And so it's a market, and it's trending higher or it's not. And so you kind of forget sometimes that that's all it is. You don't need to understand how it works and how it's calculated. When the trend reverses, get your butt out of that. And so when it reversed, I didn't get my butt out. I just sort of stayed in. It's an investment. I had another category in my brain. And don't ever think like that. It's not another category. It's the same category. Do all you can to take these rules or these systematic approaches and apply them everywhere. But so often, to my surprise, I have forgotten about that. Oh yeah, just look at the chart. That's right. So that's kind of funny.
Well, I love that you humanize it because, you've had some great success with trading, obviously. And, this wonderful life experience with one of probably the most famous Wall Street story. I don't know of one that, there's other stories, but my gosh, I think everyone knows of the turtle story. So I think it's cool when you go ahead and say, even though you've been down this path and had all this great success, you say, gosh, there's moments in time where I kind of left what I otherwise know should be the right thing.
I do. I think that, I do think that I've been pretty darn good at incorporating single stocks into our trading program, being pretty adamant about using the same trend approach, the exact same trend approach to the stocks that we use for the currencies, commodities, and interest rates. I think that's one of the things I'm very mystified by is I do have a lot of trader friends who, number one, don't choose single stocks. They want to trade the indices for some unknown reason. And then because the information is there on single stocks, I've got to use it. So there's so much fundamental or even mathematical calculations out there for the stocks that, thankfully I don't have to just use trend like I have to do in the commodities and interest rates and in foreign exchange. But now I can add this other ways of choosing the stocks and trading the stocks and blend the trend in together. I think that's, a total mistake. And, I'm sure at some point in time, due to market performance that people will change, but maybe I shouldn't be wishing for that. But I do think that we're all sort of contaminated by how we were grown up and been influenced by a fundamental approach to equities. I used to watch Wall Street Week and Marty Zweig, and now it's CNBC, and I think we all don't even realize how we're influenced by Wall Street and indices and passive indexes and things like that. And this is how the stock market works. And it's not the same as what you do. Wrong. It's the exact same. Watch me.
You brought up, as I was asking about kind of a personal approach to applying trend following, you brought up sports, early days in Chicago. And I was just thinking of something that I've been watching from afar. I've been watching Aaron Judge's batting statistics this whole year in 2017, the first half of the year prior to the All-Star game. Literally the guy might win the Triple Crown. He might set the home run record. And what's, just the statistics that are backing the performance, it's all there. And then post the All-Star game, he's literally been in a 45-day slump, almost 2 months, striking out twice a game. You have to wonder that if you were going by a pure statistical approach or a pure math approach, that you might have, if you were the Yankees, if you were Girardi, you might have made a decision earlier to change things. I know he just got benched recently. And look, I'm a big fan. I hope he turns it around. But it's really amazing how numbers and how we can look at numbers and stats in something like baseball, and the decision making is still kind of all over the map. There's not yet a generally accepted way to handle baseball performance and how to make managerial decisions. So it's interesting to watch that, isn't it?
Well, there might be, but no one's talking about it. And if they do have a way of doing it, they're probably not going to share it. I think Judge, I'm a Yankee fan, and I think that he, it's just small sample size. That's a convenient excuse. I know it sounds like it, but it's probably true. And then does he adapt to the changing fundamentals, i.e. people figuring him out, as well as trend following does, So we're great at when the fundamentals change, trend following adapts automatically. So he needs to adjust a little bit and change his systematic approach, correct some of, just like I have over the years. There was a big change that, in my mind, that happened in the late 90s where the shorter term trend following no longer worked. So you've got to change and make that decision, make that call. And so maybe he needs to do some of the same things, then go right back to following a new improved system. So I'm not saying that things can't fundamentally change, but yeah, hopefully they get it all squared away. And baseball is fascinating, and it's probably not exactly like trading, but definitely people have seen the benefit of using numbers.
As I let you go, I have to ask you, anything that I've not asked about today that's near and dear to you, or any resources that really capture your attention these days? Any white papers, any people you're following on Twitter that really amaze you, any books, anything you might want to turn people onto that really captures your attention these days? Obviously, you can see a lot of things that capture your attention on Twitter, and it's there every day. But I'm just, I'm just fishing for something interesting.
It's a good question. Well, obviously, I love Cliff, and I think that he is really fun and interesting to listen to, and his papers. I just think... What
strikes you? You're talking about Cliff Asness of AQR. What strikes you about him? Where's your respect for him derived? I've had a lot of success, but I see a lot of commonality in how he thinks and writes, especially with you. But give me what pulls you in from him?
Well, I think number one, he's funny. And he's a smart person who's funny. So he's humble, and he doesn't overstate. He tries to get to the honest truth of situations and trend and diversification, and add value to the knowledge base of everyone. Yeah, I'm a big user of Google Alerts, and so I have a lot of Google Alerts, and I love to keep up with my competition and what people are saying about topics and people that I'm interested in. So I think Google Alerts is just a great thing. I have a Google Alert for MICHAEL Coveel, so if you're ever in the news, I'm gonna be the one who's gonna know about it first. So yeah, I think staying on top and listening, and I'm just off. I think the young people of today that I run into, a lot of them, they're not that interested in listening to sage advice, and they want to write it off, and they'll tell me, no, I'm more interested in you understanding what I'm going to do and how I approach these problems, and let me tell you where you need to be corrected. And so I was the exact opposite. I was a sponge.
So was I.
I was a sponge for all this information, and I was building my own worldview on trading, obviously sticking to what I had learned from Richard Dennis and Bill Eckhart for the most part, but still open-minded enough. And then a lot of times, if I didn't really understand something or didn't really agree with it at the time, I would just still write it down and revisit it ever so often. And in most of those situations, I was only able to understand and agree years later. I put the burden on myself. It was like, I don't think this is right. I don't understand how this can be right. But this is a person that has many years and seems like an honest person. So it was my own shortcomings that didn't allow me to understand, the depth of this person and how it didn't really jive with what I thought was correct. So I think just having this open mind and reading and don't dismiss things that you don't understand or agree with quite yet, because you may find out that you will agree later on when you yourself are a little bit more mature and ready to handle, things that you think you already know.
That is a fantastic one. I've been thinking about that for a long time. I don't think I've worded it in my own head that way, but I know when I started gathering information, all I wanted to do was probe the minds of people that came before me. What did those guys and gals know that I don't know? What can I learn from them? And the point that you the really important thing that I think you just said there, and I don't think you're not trying to be one of those guys that says, oh, those young kids and the music they listen today. That's not what you're saying at all. That's not what you're saying, really, because I see it all the time, and I'm a little bit younger than you. And the point being is a lot of generations right now, perhaps under 35, under 30, I'm seeing this. Well, this Jerry Parker guy, he might be smart. He might have gone through all this stuff. But you know what? I want him to listen to me. I want him to feel what I'm feeling and let him listen to me first. And it's the craziest mindset I've ever seen. It's nuts.
I think another thing that creeps into everybody is just the desire that there's something else out there. And I remember in the Turtle class, a handful of people would say, well, I don't think they told us everything we needed to know. They're keeping secrets from us. We'd say, well, why do you say that? And they'd say, well, because we're having a drawdown. I think that what creeps in is there must be the Holy Grail. There must be something better out there and perfect out there. And then this breeds in, more variables and a style of trading that people just don't want to face the bad news that it's not going to be but so good. And that's one of the things we were taught from early on. Like, this is not that great. The markets are not that easy, not that great. You're not going to be able to find something that is amazing. There are people out there who do this, Renaissance, let's say. But for the vast majority of us, it's not easy. So if you get research results back that look too good, you got to be very careful. And I think that this healthy skepticism of what's even possible in this world, it gets lost on younger people or older people too. They're just pretending that we can figure all this out when you don't even need to figure it all out, because I never did. And I made so many mistakes growing up in this business that it's just amazing how the trends and being diversified will bail you out when you're making so many mistakes at the same time. I like to specialize on nuances and little things that I think are correct and nobody else thinks is correct, or I'm doing this the best way and nobody else is, and people aren't listening. But the fact of the matter is, it doesn't seem to really matter that much. There's so much leeway and so many ways you can do things slightly off. But as long as you get in that big, huge trend, as long as you're long Bitcoin, that's going to make up for a lot of problems that you will never even know and figure out that you had a problem. Trade small and go with the trend. That you really can't beat it.
10 seconds. I have to share with you. I got an email from a young guy. He said, hey, I listened to 1 hour of your 4-hour Tom Basso interview, but it was just too long, so I stopped listening. And then he started talking about something else. I wrote him back. I said, why are you not listening to the full 4 hours? I mean, that's really good stuff for your financial future. And he said, well, it's just, I like to read things. I don't want to listen. And I said, well, I don't think that exists anywhere else except in audio form. And he literally argued back and forth with me. And he's a 20-something guy, argued back and forth with me for like 3 or 4 emails. And I just did it so I could see what he was going to say each time, because it was more fascinating each time. And by the end, he basically says, well, I prioritize my time and I just don't have time to listen to 4 hours. I just, okay.
Wow.
You win, man.
Yeah, that's right. Patience. Yeah.
It's crazy. Hey, so your Twitter feed is the best place to find you. And I think the easiest thing is probably just to type in Jerry Parker in Twitter. And I do think you come up number one for Jerry Parker. Website, Chesapeake website, if they want to check you out also.
ChesapeakeCapital.com.
Jerry, thanks for taking the time. As you can tell with yourself, you can probably tell this though, you get warmed up, right? Now, if I kept you going on for another 2 hours, you would just kind of be flowing and going. See, it's interesting, right?
So just turn the recorder on after the first hour of us chatting the next time.
No, it's all great. It's all great, man. I mean, you gave a lot of really interesting insights. I'm sure people will enjoy it.
No, thanks a lot for having me. I appreciate it.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.